If you are about to retire, or if you have retired a few years ago, this video is for you. I'm going to tackle 3 risks at retirement that you can avoid because I have those solutions. As you know, I work as a financial planner for 10 years, helping Canadians build their plan, follow it, and enjoy their retirement. Since last year, I created a community called Retirement Loop where there are all loopers where we build our retirement, we help each other, and we answer those important questions. So let's get started with risk number 1, paying too much taxes. Paying too much taxes. I mean, we all fear to create this RRSP tax bomb when we pass away. And then we have like over $1 million at the age of 80 in RRSP, and then boom, our estate has to pay I don't know, like a 50% tax rate. That's being generous with the government, right? So maybe because of that fear, we focus on melting down our RSP too fast or not fast enough. And then there is this big problem of managing all the other sources of income. So you're thinking about OAS, other government benefits. Maybe you have a pension. Maybe you have rental income. And at one point, if you do not have a clear plan, well, you're all over the place. So the solution to not pay much taxes is to have a clear financial projections, and then you run multiple scenarios. The one that will be the best one for your situation is when you can manage all your sources of income, but never pay a higher marginal tax rate. So if you always stay in the same tax rate bracket, you will be in a good position. So we're focusing on a smooth type of revenue over time, so you never have any peaks, and therefore you're not going to pay too much taxes to the government. For example, there are 3 ways to withdraw money from your RRSPs. The first one is the equal withdrawals. So equal withdrawals, super simple, very straightforward. You decide that you need $10,000 from your RRSP, you withdraw that $10,000 each year, you adjust it for inflation, that matches your expenses, and there you go, you're golden. The other way that you can do it is to actually postpone your RSP withdrawals until you turn the age of 71, and then you convert everything into a RIF. Once it's into a RIF, you set up the minimum withdrawal, which has this advantage of being super simple, but on the other side, the problem is likely you're going to pay a lot more taxes. So as you can see, those 2 withdrawal strategies could be interesting, but probably will end up into a higher tax burden for your retirement. There is a solution called the smooth withdrawals, or as I like to call it, retire each year. So every year you look at your different sources of income and then you manage them to pay the least amount of taxes as possible, or to actually equal the tax rate that you're going to pay into retirement. So again, you can do that with a financial projection sheet. We have one at Retirement Loop, where you can actually optimize all your sources of income to make sure that you never pay a penny more. Speaking of which, I host a free webinar next week about 6 upgrades for your retirement. So we're going to talk about investment fees, tax optimization, when to take CPP and OAS, how to build this retirement plan and optimize every single part, and making sure that you're doing the right things. So you can register for free at retirementloop.ca/webinar. So that's retirementloop.ca/webinar. So now let's move on to risk number 2, withdrawal sequence and market volatility. So imagine that you are about to retire, but not in 2025, rather in 2000. And then boom, you get hit by the dot-com bubble. And then a few years later, as you're finally crawling back to positive territories, you get hit by the financial crisis of 2008. So imagine retiring into the lost decade, 10 years where the S&P 500 actually generated nothing. So if you had a balanced portfolio, maybe you got lucky and you got some Canadian stocks, and maybe your portfolio generated like 30 or 40% total return over 10 years. But that's not that much, especially when you are withdrawing. And when you're withdrawing during a bear market, you're literally canceling years of your retirement plan, and this is a big source of concern. Especially right now, the market feels a bit at a high time value, a bit overvalued, and then we all fear that there's a big big correction right around the corner, ready to crush our retirement plan. So is there a solution for that? Well, there is actually. Instead, you can have your portfolio split into two parts. Part number one, the strategy that you have followed for many decades, that you are confident in, that you understand, and that you can sleep well at night. Part number two, use a small percentage of your portfolio as a cash reserve, or also known as cash wedge. The goal of the cash reserve is to bridge the gap between the income generated from your portfolio and the amount that you need to withdraw each month. I've covered this topic several times, but if you want to learn more about it, I suggest that you register to the webinar, as I mentioned earlier, at retirementloop.ca/webinar. So having this cash reserve means that on a bad year, when the market is down, instead of selling your shares at a loss, you just take some of that money back into your pockets and then you keep on with your retirement. On a good year, your portfolio is up. You can sell shares, you can sell units of your ETFs, and then generate your own income. So you get in control, you have flexibility, and most importantly, you're not going to get hit by a bad sequence of withdrawals. Next one, risk number 3. Not spending enough. Counterintuitive, right? But a lot of people will tell you, oh, the risk is overspending because you're going to minimize inflation, you're going to minimize healthcare costs, you don't know what's going to happen. And I get it. I mean, you get into retirement and then you fear that you're going to outlive your portfolio. We just talked about the bad sequence of withdrawals during the lost decades, but imagine that you're just overspending. But is there a possibility that you could actually balance the fact that you don't want to die at 84 with $2 million in your bank account where you have absolutely not enjoyed, and on the other side being 84 and having $0 in your portfolio? And the solution is actually quite simple. The solution is to retire each year. By retiring each year, you run your calculations every 12 months. So you're still always on target. You can adapt your budget depending if you have a good year or a bad year on the stock market. And then you can also fast forward some adjustment in your budget, such as a big cruise or helping your children, or doing the other way around and postpone some major event for your budget in a few years when the market will permit it. Again, if you want to know how to do that with a Excel spreadsheet, we're going to teach you how to retire each year during the webinar next week at retirementloop.ca/webinar. All right, that's enough for today. I hope that you have enjoyed this video. Do not forget to like the video and subscribe to the channel to not miss next week, where we're going to talk about the 3 methodologies to withdraw money from your RRSPs. And until then, don't forget to stay invested.